Assalamualaikum guys. We are now going to look at part 3 about the leverage ratio as well as the capital adequacy ratio, because both Basel III leverage ratio and Basel III capital adequacy ratio of 10%, it is a system that allows the commercial bank to use leverage money or deposit fund to make loan or to make murabaha for Islamic banking. For leverage ratio of 3%, it implies that the bank would be using the leverage money or deposit to make risk-free loan, that is to buy government bonds or government treasuries. Whereas when we look at the Basel III capital adequacy ratio of 10.5%, so we are looking at the use of deposit fund or leverage money to make loans, to make risky loan, and we will have that risk weighting system introduced to provide an idea how much capital will be charged against the exposure. But the main idea here is to understand that the banking system is based on leveraging. It is using leverage fund to make loan, or for Islamic to make murabaha. And for that reason, when the bank uses leverage fund or deposit, or when they use borrowed money to make loan or to make murabaha, regulation require the bank to hold some amount of capital or some amount of bank owns money. So this is where the shareholder will have to, put some commitment, meaning that there is skin in the game, that the bank or the shareholder will have to put up some of their own money, against this exposure, to ensure that if there is a loss from default, then there is ample resources to pay for these losses. So meaning that regulation require the bank to hold capital against the loans or against the murabaha, but that amount of capital is minuscule, or it is in a smaller proportion compared with the exact amount of loan or murabaha transacted in the respective banking system. So what I'm trying to convey here is that this notion of capital adequacy, right, whether it is coming from the Basel III leverage ratio or the Basel III capital adequacy ratio, the main idea here is that bank must hold some of their own money against the loan or against the murabaha to absorb any eventual losses arising from this exposure. So when we have this kind of requirement of capital holding, then bank would be much more careful in making loans, because if they are not careful, then when the loan fall into default, then banking capital will be adversely affected. So there will be a contraction of banking capital when the losses, when capital is used to write off the losses coming from the default. So this is why I was raising this issue about the capital charges will be one of the impediment in the use of al-bay', in the use of real sale, real leasing, partnership, and forward sale under salam and istisna, because by default the al-bay' contract are risky because they are exposed to business risk, right? They are exposed to the vagaries of the demand and supply, the market forces that will change prices, and this will affect the asset under the pretext of through sale, through lease, partnership, istisna, and salam. So let us just look a bit more on this leveraging or leverage money that the bank uses to make loan or murabaha under Islamic banking. And I was saying earlier that by using leverage money to make loan, the Basel Court require the bank to hold some of their own money, that is equity capital, to support these loans or murabaha for Islamic against a loss from default, right? So because the bank is using other people's money, which is deposit, to make the loan or to make the tawarruk, hence there may be some possible moral hazard, that can occur when bank become negligent or irresponsible, making loans to connected parties, and and ending up in losses because they say that this deposit are not our money, it is other people's money. So what the heck, right? So regulation required bank to hold capital against this asset, loan asset or murabaha asset. So capital serves like an insurance or collateral against potential losses, but the amount of this capital that was put against the loan or murabaha is disproportionately low, that often favors the bank because the amount is of course not equivalent to the exact exposure, but a fraction of the size of the exposure. So when we look at the leverage ratio of 3%, so meaning a 3% minimum of leverage ratio, it is equal to the tier 1 capital. So this is the shareholders' money required by regulation to be put against the loan exposure divided by this loan exposure or by the murabaha exposure. Okay, so and we can see that when we look at leverage ratio of 3%, it is just the beginning, meaning that with a 3% leverage ratio, it will be guiding the bank to say, okay, you can raise, if you have a 1 million equity capital, then you can make a loan up to $33.3 million, and that is funded by leverage money, funded by deposit fund of 33.3 million. So meaning that if we have the leverage ratio of 3% and a capital of 1 million, then we should be able to get a size of, meaning that the bank can make a loan or murabaha up to 33.3 million, and which is funded by leverage money, funded by deposit fund. So this is the precursor of the leverage system. But when the bank go into real banking business where money can be made by giving a risky loan, because risky loan will charge higher interest rate. So if the bank want to be more aggressive, to make more money, to increase earning, they can be more so-called, they can reduce the collateral requirement, or they can give away unsecured loans, because these loans will command higher interest rate. Then we can go into the Basel III capital adequacy ratio of 10.5%. But if you look at the so-called leverage ratio, as the beginner's playground, where let's say if the bank holds a $10 billion dollar capital, right? Then based on the 3% leverage ratio, 3% is equal to 10 billion divided by the asset. So how much can the bank make? How much loan the bank can make, and that would be 3.3 billion. So meaning that for leverage ratio of 3, we assume that the bank must invest in risk-free government bond of 3.3 billion, funded by 3.3 billion of deposit or leverage money. And we can see that based on this modality, that the bank can easily, make profit of 6.7 billion, right? Meaning that 4% of the bond yield multiplied by the 333.3 bond investment, that will give us 13.3 billion, and then we will minus the cost of fund of 2% on the 333.3 billion leverage money or deposit, and that will give us 6.6. So the earning coming from this simple leverage system is that the bank can make 6.7 billion by just holding a capital of 10 billion, whereby they are allowed to raise deposit or leverage money up to 3.3 billion, from which they will make or they will buy government bond. So this is a very simple illustration of how the bank are allowed to use borrowed money or leverage money that is deposit to generate risk-free asset, and thus making some decent earning. But when we look at the actual, banking operation, where the bank simply cannot make, or the bank will have to diversify their reserve into cash, into loans and advances, and government bonds, right? So meaning that if the bank wants to increase earning, where they can charge above 4%, meaning that if they make credit card, they can charge up to 30%. If they make personal loan, they can charge up to 15%. If they make mortgages, that they can charge up to 7%, 9%. If they were to give auto finance, they can charge up to 5%. So the spread from this risky loan are much higher than the risk-free bond. So we can see that if the bank is to get into this, the making of risky loan, which is actually what a bank is doing. I mean, the business of banking is to make risky loan, because if they were to make zero risk loan, then the earning from this loan are very minuscule, are very minute, and bank will not be interested, to essentially sustain that kind of business model. So the idea is to make risky loans so that bank can make more profit, but then that will bring us to the issue of another leverage system under the Basel III capital adequacy ratio of 10.5%. So if you look at the current CAR ratio of 10.5%, meaning that we are recognizing that banks are making risky loan, and these risks are weighted, by virtue of the RW system. A risky loan, an unsecured or clean loan, the risk weight can be, it can be 100 to 200%. So for this particular loan, for example, let's say that the risk weight is 50%, so it is not fully secured, but there are some kind of guarantees accorded to the exposure. So if the bank is holding 10 billion worth of capital, which is tier 1, then based on the minimum capital ratio of 10.5%, then the bank should be able to make loan up to 190